Welcome to the Deep Dive.
Great to be diving in.
Our mission here is pretty simple, really.
Yeah.
We take a stack of sources you've given us, could be articles, research, maybe just your notes, and we unpack them.
Yeah, we pull out the key insights, the knowledge nuggets.
Exactly. Think of it like a shortcut, helping you get really well informed on a topic that actually matters to you.
Cutting through the noise, essentially.
And today, we are doing a deep dive into some, well, frankly, fascinating analysis of the U.S. stock market. We're looking specifically at what's happening right around now, June 5th and 6th, 2025.
Absolutely. We've gathered insights from quite a mix of sources. We've got the very latest economic data, some fresh commentary straight from the Fed, market valuation analysis, sector trends.
And then we're drilling down, right, into specific stocks.
Yeah, detailed breakdowns of a few key stocks that have seen some really interesting action or news just recently.
Okay, so the goal for this deep dive, we want to clarify the sort of opposing forces at play in the market right now. There's stuff pulling it up, stuff pulling it down.
Right. Understand what this flood of new data actually means in context.
And then look at some concrete examples from the sources, these individual stocks, to see how all this conflicting information, these new catalysts, how they actually play out.
So you walk away with, hopefully, a clearer picture of the landscape.
Yeah, maybe even a few aha moments connecting the dots. Okay, let's get into it. Let's unpack this.
All right, so let's start where the sources do, with the big picture, the macro view, because it's definitely shifted, even just in the last day or two. Analysts are having to reassess.
Okay, what was the baseline before things shifted?
Well, coming out of April, things felt, relatively okay for the Fed. The April CPI data showed inflation moderating a bit. It was 2.3% overall, 2.8% core year over year.
So that kind of suggested the path was clearing, maybe, for the Fed to think about easing policy down the road.
That was the thinking, but that's kind of old news now.
Right, because you said things shifted. This is where it gets interesting. Brand new data.
Exactly. A whole flurry of new data points just hit the wire, shaking things up and really feeding into the outlook for today, June 5th, and tomorrow.
Okay, what's the first big one?
First up, the ADP employment report for May. That came out yesterday, June 4th. It estimates private sector job growth, and it showed a really significant deceleration.
How significant?
Just 37,000 jobs added.
Wow, 37,000, what was expected?
Forecast was around 115,000, so way off. And it's the lowest number since March 2023.
Okay, that's a big slowdown. Where did the weakness come from?
Services added only 36,000 jobs, and the goods-producing sector actually lost 2,000. Pay for job shares, though, was still up 4.5% year over year.
Adding only 37K private jobs? That feels like a pretty strong signal the labor market is cooling off fast.
It does. And then compounding that, the ISM Services PMI for May also out yesterday.
Right, the services sector index. Huge part of the economy.
And it dropped to 49.9.
Ooh, below 50. That means contraction, right?
Exactly. Anything below 50 signals contraction. It was down from 51.6 in April and missed the 52 forecast. It pointed to stalled production, contractions in new orders, inventories, backlogs.
And any reason given for that weakness?
The sources mention it's partly being blamed on uncertainty around trade tariffs.
Okay, so yesterday we get much weaker private job growth and the massive services sector possibly shrinking. That pairing sounds like a pretty potent economic signal.
It is, and the market reacted instantly. Now, fast forward to today, June 5th, we got more data. Revised U.S. Q1 2025 productivity and costs.
Productivity, how much we produce per hour. What did that show?
It actually decreased 0.8%. That's the first drop since the second quarter of 2022.
Okay, productivity fell. What about costs?
Here's the tension point. While productivity fell, unit labor costs, basically what businesses pay workers for each unit of output, they increased a hefty 5.7%.
Hold on, so less output per hour, but businesses are paying 5.7% more in labor costs for that lower output.
Precisely. Real hourly compensation, adjusted for inflation, was up 1%.
That feels like a recipe for margin pressure for companies, unless they can pass those costs on, which could mean more inflation pressure.
That's the core tension for the Fed, exactly. Their dual mandate. Jobs and stable prices. Weakening jobs and services point one-way concern about a slowdown, but rising unit labor costs make the inflation fight trickier even if demand cools.
It's a real balancing act. What else came out today? Jobless claims.
Yep. U.S. weekly initial jobless claims. For the week ending May 31st, they came in at 229,000.
How does that stack up?
Slightly better than the forecast, which was around 236K, and it's a bit lower than the previous week's revised 232,000. So fewer new layoffs than expected.
Okay, but what about people still on unemployment? Continuing claims.
Those did tick up, rose to 1.927 million.
All right, so initial claims slightly better, continuing claims rising. But the big picture from ADP and ISM yesterday was pretty weak. How did the market process this really mixed bag?
Well, that mixed bag, especially the very weak ADP and ISM reports yesterday, they immediately triggered a sharp shift in market expectations for the Fed.
Ah, rate cuts.
Exactly. Expectations for rate cuts this year jumped significantly. The market's now pricing in maybe 2 cuts, possibly October, December.
Okay. And Treasury yields reacted how?
Dropped sharply yesterday. Lower yields reflect those increased expectations for slower growth and potential Fed easing.
Right. So the market logic is weaker datas, economy slowing, Fed more likely to cut lower bond yields. That link seems crystal clear from yesterday's reaction.
It really was. And the Fed itself, Governor Lisa Cook spoke on June 3rd and 4th. Her comments echoed this increased uncertainty.
What did she highlight?
She specifically mentioned trade policy as a potential wild card impacting both inflation and the labor market. They're sticking firmly to being data dependent. And this latest data certainly gives them more to chew on, leaning towards easing if this weakness continues.
And those trade tensions, particularly with China, they're still simmering, aren't they? Something about new tariffs?
Yeah, the sources flag that as an ongoing risk. A 50% steel tariff actually became effective today, June 5th. And there's no sign of finalized trade deals soon, just adds another layer of uncertainty.
Okay, let's try to summarize this picture. We've got clear signs of economic weakening, especially in jobs and services.
Right, which boosts hopes for Fed rate cuts, generally good for markets.
But unit labor costs are still stubbornly high, potentially keeping inflation sticky. And these trade tensions add uncertainty to both growth and inflation outlooks. It's genuinely complex, forces pulling every which way.
It really is, and it perfectly sets up these different scenarios the sources are outlining for what might happen next. This is where you get that sharp confrontation of ideas about the future.
Okay, let's hear them. What are the high probability scenarios?
Based on this whole complex setup, the sources focus on 3 main scenarios.
Scenario number 1.
Scenario 1, muddling through with an easing bias. This gets the highest probability. One source puts it around 60%.
Okay, muddling through, what does that actually look like?
It means the economic data stays weakish, like we've seen with ADP and ISM, but it doesn't suddenly crater into a sharp recession. Inflation cools down, but slowly.
And the Fed?
They hold rates steady for now, but clearly signal they will cut later this year if the weakness keeps up, or if those trade issues really start to bite. The market kind of settles on expecting maybe 1 or 2 cuts by year end.
That 60% probability suggests this is seen as the most likely path, given where we are now slowing but not crashing.
Exactly.
And what's the market bias in that muddling through world?
Generally, cautiously bullish to neutral for stocks overall. The prospect of rate cuts offers some support, but the growth concerns keep a lid on things. And within stocks, the lean is towards value and small caps, which look relatively cheaper according to Morningstar analysis from late May.
Okay, makes sense. Scenario 2.
Scenario 2, tariff shock and growth scare. This one's given a 25% probability.
Sounds less pleasant.
It's the main downside risk scenario. Either trade tensions escalate way beyond current levels, or maybe the existing tariffs just hit the economy harder than anticipated. Either way, it causes a sharper, faster slowdown in growth and company profits.
And in that case, the Fed.
They'd likely be forced to cut rates sooner, maybe more aggressively, to try and cushion the blow, stop it from becoming a deep recession. That 25% reflects the real risk that trade talks go south or the impact is underestimated.
How would the market react to that?
Initially, probably bearish for stocks because of the shock to growth and earnings, but then maybe a rebound if the market thinks the Fed's action is going to be enough stimulus. You definitely expect volatility to spike, lots of sharp moves.
Got it. Bearish first, then maybe a Fed-induced bounce. What's the third scenario?
Scenario 3, inflation reacceleration or resilient growth. This gets the lowest probability, around 15%.
So this is the opposite. The economy or inflation surprises to the upside.
Exactly that. Either the economy proves much stronger than this recent weak data suggests, maybe ADP and ISM were just a blip, or perhaps those tariffs really mess up supply chains, causing inflation to pick back up, overriding any slowdown in demand.
And if that happens, the Fed.
Would have to delay rate cuts even longer. Maybe even get more hawkish if inflation really takes off again. That would completely dash the market's hopes for easing policy. The low 15% probability suggests this isn't seen as very likely right now, given the recent data flow.
Right. So the weak data we got yesterday and today really bolsters scenario 1, the muddling through idea, makes Fed cuts seem more probable.
It does.
But the risk of trade wars escalating, scenario 2, or inflation staying high because of labor costs or supply issues, scenario 3, those risks are still out there, keeping things uncertain.
Precisely. That's the core tension, slowing growth versus these potential inflation and trade shocks. It highlights that even if one path seems most likely, you absolutely have to keep an eye on the risks.
Okay, that gives us a great framework, the big picture, the potential paths. Now let's dive into those specific stocks mentioned in the sources. This is where we see how these broad themes, these catalysts, actually play out company by company, where the rubber hits the road.
Yeah, let's do it. Let's start with the giant in the room. NVIDIA, NVDA, still absolutely central to the AI narrative. Market cap around, what, $3.5 trillion now? Insane.
Their Q1 earnings back on May 28th were strong, right? Despite export control.
Incredibly strong. Continued demand navigated the controls well, and analyst sentiment still overwhelmingly positive. Price targets are climbing, some hitting $190.
The story there is just so powerful. How do the technicals look after that huge run-up?
Well, the technical analysis shows a very strong uptrend, no question. Price is way above key moving averages. Indicators like MACD, measuring momentum, still look bullish.
I sense a but.
But some other indicators, like the RSI, the Relative Strength Index, it measures the speed and change of price moves. It's getting up there, nearing what traders call overbought levels, somewhere between 62 and 68, depending on the source.
Meaning it's gone up very fast, might be due for a breather.
That's the typical interpretation, yeah. A pause or a pullback wouldn't be surprising. Also, one source noted trading volume on June 4th was actually below average. Sometimes that suggests buying pressure might be easing off a bit.
So strong underlying trend, powerful story, but maybe a little extended or tired in the super short term.
Could be. Now, quant data that's looking at systematic trading patterns shows very low short interest, only about 1%, so not much fuel there for a short squeeze.
Okay. What about options activity? That can sometimes give clues.
Interesting point there. On June 4th, there was notably high volume and a spike in open interest, meaning new contracts opened in near-dated puts. Specifically, the $140 puts expiring tomorrow, June 6th. These are out-of-the-money puts.
Puts.
Yeah.
Those are bets. The price goes down. Or protection against a drop, right? What does that activity suggest? Hedging or betting on a fall?
That's the tension, isn't it? It could be hedging. Investors sitting on big gains might buy puts for short-term protection after such a massive rally. Seems plausible. Or it could be new speculative bets that a pullback is coming very soon.
So we've got this incredibly positive AI narrative, great earnings, bullish analysts versus some technical caution flags, RSI, volume, and this potentially protective or bearish options activity. How do the sources see this resolving in the very near term?
The analysis suggests the most likely path near term is some consolidation. Maybe the stock chops around the $139 to $143 level for a bit, digests the huge gains.
But longer.
But the underlying fundamental strength and that powerful positive sentiment, they remain very strong, suggesting eventual upside is still the base case after any pause. A decisive break below $139 on heavy volume, though, that would be a warning sign.
Okay, consolidation likely, but underlying trends still strong. Let's shift to another AI-focused big tech name, Meta Platforms. Meta. Market cap around $1.74 trillion.
Right. And Meta had some major news just yesterday, June 4th, a huge catalyst the sources flagged.
So what was it?
They announced a 20-year deal to buy nuclear power for their AI data centers from Constellation Energy.
Whoa, nuclear power for data centers. That really underscores the massive long-term energy needs for AI, doesn't it? Securing that kind of power source.
It absolutely does. It's a massive concrete commitment to fueling their AI build-out. It tackles that key constraint head-on. Where do you get all the power? Analysts reacted positively too. JPM, for instance, bumped their price target up to $735.
Big news. How did the market, especially the options market, react to this one? Similar tensions to NVDA.
Incredibly active options market, yeah. And fascinating dynamics. Similar to NVDA, there was heavy volume in some out-of-the-money puts expiring tomorrow. June 6th specifically, the $677.50 strike saw huge volume.
Okay, so maybe some hedging there too.
But, and this is a big but, simultaneously there were reports of massive bullish call block trades, like $77 million worth, buying June 20th calls at the $720 strike price.
Wow. So that is a sharp contrast. You've got potential hedging or near-term bearish bets with the puts, but huge explicit bullish bets being placed further out with those calls.
Exactly. Clear tension, showing different strategies or views. But overall, the sentiment on Meta is predominantly bullish right now, really boosted by that nuclear power deal. It's seen as validating the scale and seriousness of their AI plans.
So how does the analysis weigh these conflicting signals, the super bullish news and those big call buys versus maybe some hedging puts or, like one source mentioned, an overbought RSI reading around 78?
The takeaway seems to be that the powerful, fresh news catalyst, that PPA deal, and the clear signal from those large bullish call trades likely outweigh the temporary technical readings or the ambiguous put activity.
So expect follow-through buying.
Yeah, the expectation is for buying momentum to continue after maybe a brief pause to digest the news. Eyes on whether it holds above, say, $689.
Okay, let's switch gears a bit. Different part of the tech world. On semiconductor, on N. Exposure to auto and industrial markets, smaller cap around $21 billion.
On N had a really dramatic, very clear catalyst happen just this week, June 3rd and 4th.
What was that?
Their CEO, Hassan El-Aouri, spoke at a conference, and his comments signaled a demand recovery underway in industrials and, critically, a potential bottom forming in the automotive chip market in Q2. The sources described him as sounding upbeat for the first time in 2 years.
Wow. A CEO shifting tone like that after 2 years of caution. That is a major signal for investors.
Yeah.
How did the stock react?
It absolutely exploded, up 11% on Monday, June 3rd, then another 6.1% yesterday, June 4th. It was the top gainer in the S&P 500 yesterday, all on massive, way above average volume.
Huge move, huge volume. What does that do to the chart, the technical picture?
Well, it creates a very strong bullish breakout pattern. The high volume confirms the move is real. But because it moves so far, so fast, up over 17% in just 2 days, it's now extremely overbought on a short-term basis.
Right. Very vulnerable to a quick pullback or profit-taking after a spike like that.
Exactly. That's the risk now. Quant Analysis notes that Onan had significant short interest before this, so part of that huge surge was likely short covering bears getting squeezed out and forced to buy.
Makes sense. Any options activity?
Yeah, bullish call activity was seen even before the market opened yesterday. Specifically, August $70 calls, indicating speculators were jumping on the news very quickly. Sentiment here has clearly done a complete 180, a dramatic, positive reversal from the caution seen after their last earnings report.
So the conflict is incredibly powerful catalyst, strong momentum, clear breakout, versus this extremely overbought condition signaling high near-term risk. What's the likely resolution?
The analysis suggests you might expect continued momentum initially because the catalyst is so strong and the short covering might have more legs. But the risk of a sharp pullback is very high now. For anyone thinking about jumping in now, it's flagged as higher risk unless the stock can consolidate first, build a new base above maybe $47 or $48, proving the gains can stick after this initial frenzy.
Got it. High momentum, but definitely handle with care right now. Let's touch on another name mentioned. Sterling Infrastructure, STRO, involved in E-infrastructure data centers.
Exactly. Smaller cap, around $4.5 billion. The sources highlighted an interesting convergence here. Technically, the stock recently formed what's called a golden cross.
Ah, the 50-day moving average crossing above the 200-day, often seen as bullish.
That's the one. It's a signal technical analyst's watch, often suggesting potential for a longer-term uptrend.
Okay, so a technical signal. What's the fundamental story backing it up?
The fundamental story is its strong position in that booming E-infrastructure space, especially building data centers needed for AI and cloud computing. Huge demand there. The sources say STRL is benefiting, and importantly, they report seeing signs of institutional buying big money accumulating shares.
So you've got a classic bullish technical pattern aligning with a strong growth story in a hot sector, plus institutional support. Seems like a solid combination.
Yeah, the sentiment seems increasingly positive, driven by exactly that confluence of factors. Looks like a potential continuation play based on that analysis.
All right, one more. We have to mention the quintessential meme stock, GameStop, GME. Market cap around $13.5 billion, which is still kind of wild.
Yeah, GME, the dynamics here are totally different, obviously. It's all about event drivers right now.
Okay.
Anticipation of their Q1 earnings, which are due June 10th, plus ongoing speculation around that $515 million Bitcoin investment they made, and of course, just pure retail interest, social media buzz, especially anything involving roaring kitty.
And technical analysis for GME, I assume that's basically useless.
Pretty much, yeah. Notoriously unreliable, indicators will conflict wildly. Price moves are driven by sentiment, hype, short squeezes, event triggers, not traditional chart patterns.
What about the quant side? Short interest still high.
Still significant, yeah. Around 12.12% of the float last checked. That's always the key factor. Provides the fuel for a potential short squeeze if buying pressure comes in.
And options. Pricing in a big move.
Huge. Implied volatility for earnings week is sky high, around 90.5%. The market is absolutely expecting a massive price swing, one way or the other, around those earnings. Interestingly, call open interest bets on the price rising is higher than put open interest.
And sentiment is just retail hype and Bitcoin correlation.
Pretty much. Purely event-driven social media influence.
So the conflict is stark. Fundamental analysts see the business is worth maybe $13, $14 a share, versus the potential for another explosive, unpredictable move driven by retail sentiment, squeeze potential, and the earnings event. Resolution.
Utterly uncertain direction. Volatility is the only sure thing here, especially around June 10th. The sources are clear. This is speculation, not fundamental investing. Extremely high risk, not for most people.
Okay, that was a fantastic tour through how these broader themes play out in specific stocks, showing that mix of fundamentals, technical, sentiment, catalysts. Now let's zoom back out. How can you use all this? Based on that overall market view, especially that favored muddling through scenario.
Yeah, the 60% probability one.
And the sources seem to suggest a kind of cautiously bullish to neutral stance on stocks generally, and favoring value in small caps.
That's the general takeaway, yeah. Given current valuations and the potential for slower growth, but also Fed easing.
And looking at those specific stocks we just discussed, the analysis actually ranks them as potential setups, right? For someone with a balanced risk profile, excluding GME, obviously.
It does. It tries to distill the analysis into a kind of hierarchy based on the perceived setup right now.
So according to that analysis, what looks most compelling for this specific time frame?
Top of the list was Meta bullish, that powerful, fresh catalyst from the nuclear power deal, plus the analyst upgrades and those big bullish call buys. That combination seems to strongly outweigh the temporary overbought signals or hedging puts.
So the suggestion is look for follow-through.
Yeah, look for it to hold above $689, potentially targeting $705 or even $720. But crucially, define a stop loss, maybe below $677, to manage risk if it rolls over.
Okay, Meta strongest, based on that specific analysis. What's next?
Ranked as a strong follow-up opportunity was STRL bullish. Sterling infrastructure.
The Golden Cross plus data center story.
Exactly. That convergence of the technical signal, the strong fundamental growth story, and the reported institutional buying, it suggests the uptrend is likely to continue. They'd look for a break above recent highs around $196, maybe towards $200 or $206, with a stop somewhere around $189.
Makes sense. A classic setup. What about NVDA? Still core.
NVDA bullish is seen as more of a core position. The AI story is just too powerful to ignore, and the technicals are mostly positive. But that huge recent run suggests consolidation might be needed first.
So maybe wait for confirmation.
Yeah, look for it to hold and trade sustainably above $142.50 to signal more upside towards $146.50. $150 is likely. Use a stop maybe around $139. It's strong, but might need to build energy for the next leg.
And on semi, after that massive pop.
On bullish is categorized as high momentum, higher risk. That CEO catalyst was undeniably strong, caused a clean breakout. But that extreme plus 17% move in 2 days makes it super overbought and really susceptible to profit taking.
So caution advised on new entries.
Definitely higher risk for new money right now, according to the analysis, unless it can consolidate and prove it can hold a base, maybe above $47, $48 after this initial surge dies down.
It's really vital to hammer home. Like you said, this isn't specific buy-sell advice for you personally.
Absolutely not.
But it shows how the sources take all this analysis, macro, scenarios, fundamentals, technicals, sentiment, and distill it into potential strategies. And always stressing, define your entry, define your target, and most importantly, define your stop loss to manage that risk.
Exactly. Understanding the why behind the analysis and the proposed risk management, that's the key takeaway. It gives you a framework you can apply elsewhere too.
You know, as we wrap this up, here's something to maybe mull over, thinking about those stock examples. When you see those really sharp, immediate moves, like on semiconductor rocketing up right after the CEO comments or Meta jumping on that PPA deal.
Yeah, very catalyst-driven.
And you contrast that with a more nuanced picture in something like NVDA, where you've got a strong trend, but maybe conflicting short-term signals from technicals or options. It really makes you wonder, doesn't it? In today's market, with information moving at light speed, is having the absolute latest piece of news and understanding how it hits sentiment right now actually more important for short-term trading than even deep technical or fundamental work based on slightly older data.
Are we in a market where catalysts truly are king? Where the event itself, or maybe how fast the market prices in that event, overrides everything else in the blink of an eye?
Something to think about as you look at your own sources and watch how things play out.
It's definitely food for thought.
Well, that wraps up this deep dive into the market analysis and stock insights for June 5th and 6th.
We've unpacked that latest economic data, explored those competing scenarios for where the market might head, and really dove into the specifics for NVDA, Meta, ON-N, STRL, and GME, showing how different types of analysis come together.
Hopefully this is giving you a clearer, more informed perspective, cutting through some of the noise to focus on what the sources flagged as really driving things right now.
And if you found this kind of rapid, focused analysis of your source material valuable, well, you know what to do. Make sure you're subscribed to the deep dive wherever you get your podcasts.
Subscribing really is the fastest way to get our most frequent updates and these tailored deep dives sent straight to you, covering the topics and sources that matter most for your understanding. Thanks so much for joining us for this deep dive.
We'll catch you on the next one.